My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video, where I review subscriber portfolios, whether it be on M1 Finance, Robinhood, heck, if it's even on an Excel sheet, I don't care, I'll review it. Give me a little bit of context. Just keep in mind, I'm just a random guy here on the internet. I live in Austin, Texas. I don't have a finance degree or anything like that. Everything that I'm sharing is self-taught. I've learned it myself through experience, books that I've read, YouTube channels, blogs, Google, whatever. I've done everything that I know I've learned. I've been self-taught. And so I think that's important to understand. So the things that I'm sharing here, don't sue me, bro, right? I'm just sharing my opinions, but I want to share a few portfolios here that people have sent over to me via email. And in future videos, if you would like me to review your portfolio, go ahead and shoot me over an email. I'll leave my email in the description below. And just give me a little bit of context, who you are, your age, your goals. If you're new to the channel and you're interested in dividend investing, I'd invite you to subscribe. On the channel here, I share educational videos around dividend growth investing. And really, that's what the channel is all about. So if you're new or a beginner investor interested in learning about dividend growth investing, I'd invite you to subscribe. I share or I upload weekly videos every single Sunday. I have not missed a single Sunday in the last 6 months. So if you're a follower of the channel, give me a thumbs up, subscribe to the channel. There's a lot of effort that comes into being consistent the way that I'm trying to be. And, I really appreciate the support. So if you like the video, if you want to support the channel, hit the like button, subscribe to the channel. If you're interested in using M1 Finance, I have an affiliate link in the description below. Sign up with M1 Finance, support the channel, and let's dive in today's video. All right, so before we review the first portfolio here, I just want to share with everybody, if you're interested in just looking at specific portfolios, I'm going to link the timestamps in the description below so you can check those out, as well as have the links to the portfolios. If they use M1 Finance, I'll leave a link so that you can go and check out their portfolio if you're interested in that. So once again, I'm not going to say it every single second. I just want to say it one last time. Full disclaimer, I'm not a financial advisor, so don't take what I'm saying as financial advice. Let's look at the very first one from Jose. And also, really quick, before I forget, I don't look at the portfolios before reviewing them. So when I click on the link, I'm reviewing it for the first time. I haven't looked into them. I haven't pre-scripted what I'm going to say. This is, I guess, as live as it can be without live streaming it. I have not yet looked at the portfolios. So let's take a look at them. So the first one is going to be from Jose. Jose writes, "Hello, Jake. My name is Jose. Hi, Jose. I'm 27 years old, and that's brand new to investing, and recently opened an M1 Finance account on March 10th. I have a well-paying job, so I'm doing this more so as a hobby. Here are my goals for this account. I want to build this account into a 100K portfolio. I'm currently investing $250 a month. I will also start door dashing soon on my time off. I work a 4 on, 4 off rotation at Exxon. Very cool. And all of my DoorDash earnings will go into this portfolio and top off the monthly $250. That's very, very cool. The fact that you're side hustling so that you can fund a portfolio, my hat goes off to you. That's amazing, Jose. A lot of people, when they think of side hustling with Uber, DoorDash, whatever, they go and they pay off their consumer debt, which is also very, very good. What you don't want to do is go buy a brand new plasma TV, right? That's the fact that you're side hustling to fund your portfolio. Amazing. I'm not thinking short term. I'm investing for dividend income and long-term growth over time. I'm not set on a certain amount of money that I want to make off of dividends monthly, yearly down the line. I'm not set. Okay, that's the first thing. You kind of want to understand what you want to do. You want to set yourself a goal there. I just want to build a steady source of passive income. So I've shared this on the channel. First off, Jose, thank you so much for sending this over. When you write that you're not set on a certain amount of money, if you don't have a goal, it's going to be very difficult for you to navigate where you want to go. So that's my first piece of advice here when it comes to starting a dividend growth strategy. And I've shared this in many videos here on the channel, is you have to have a goal. You have to have a vision of where you're going. Otherwise, you're never going to end up where you ultimately want to be. And I would assume in this case, if you're doing what you're doing, you're side hustling so you can invest in your portfolio, it's so that you can reach financial independence, right? And so that would be the first thing that I would recommend is have a goal, right? Start off slow. Say, okay, you have a goal of reaching a 100K portfolio. Okay, now the next thing you could start thinking of is, okay, how much do I want to have in cash flow every single month? I want to have $100 in dividends every month. Okay, that could be your first goal. Your second goal could be, all right, I want to have $500 a month in cash flow, and then go up from there and think about that. Another way that you could think about it is, all right, let's look at your expenses today. Maybe you have a phone bill. Maybe you have a utility bill. Maybe you have insurance on your car, your gas payment. Think of it as like, okay, I want to have enough dividends to completely cover my utility bills, my car payment, my insurance, etc. And that's a way that you can start thinking about it. Okay, so that's what I would highly recommend. So let's take a look at your portfolio, Jose. Looking at this, it looks like you have 29 holdings, over a 3.5 dividend yield, really, really good. Also with really good performance over the last 5 years. This is double what the S&P 500 is. So I'm really curious to see what you have in here. You don't have an expense ratio, so you don't have any ETFs. Let's see what you have in telecom. It looks like in the sectors that you are invested in, they're fairly equally weighted. Let's look at telecom. Verizon, AT&T, Disney, Google. Great companies. I think Google is not a dividend payer today. I don't think they're going to be paying a dividend anytime soon. It's possible that they will in the future. Disney recently just cut their half-year dividend. I still have Disney in my portfolio. AT&T, Verizon, great picks. Healthcare, let's take a look at this. Also for AbbVie, Johnson & Johnson. 3M is not really categorized as a healthcare company, Procter & Gamble as well. So 3M is actually categorized as an industrial. Procter & Gamble is as a consumer defensive, non-cyclical. So I mean, they do have healthcare facing products, but actually they're not categorized as a healthcare company. But really great, stable companies. All four of them are in my portfolio. Energy, if I'm not mistaken, you mentioned, yeah, you're working at Exxon, so you work there, so that you have a little bit more understanding with Exxon. Okay, so energy, industrial. Okay, so you got energy, industrial. Lockheed Martin, great company, Chevron, Exxon, NextEra Energy, Waste Management. These are great companies. Waste Management, my favorite industrial. Lockheed Martin, close, very, very close behind Waste Management. Really big fan. Great companies in my portfolio. Technology, Broadcom, Microsoft, Apple, Texas Instruments. 3 of the 4 I have in my portfolio. I don't currently invest in Broadcom. I think there's a lot of growth opportunity here. My big question mark is the exposure with China and everything that's going on right now. But Microsoft, Apple, and Texas Instruments, great companies also in my portfolio. Food and beverage, Coca-Cola, Pepsi, McDonald's, all 3 are very great. I don't have Starbucks in my portfolio. I could definitely see myself owning Starbucks. I have so many at the moment. I'm focusing right now on the ones that I have, but I think Starbucks, I think all of these are just great. Let's look at your financials. Financials, you have realty income. So this is actually a REIT, a real estate investment trust. So not really a finance company. JP Morgan, DLR is actually a data center REIT. So it looks like a lot of your sectors are kind of off. Here, let me give you some help here. So when you're looking for the sector of the company, what you can do is, like, if you go to Yahoo Finance, you go to Google, you go to different websites, some of the websites will give you different information in terms of sectors. A website that I use that I really like that seems pretty consistent is Seeking Alpha. Go over to Seeking Alpha, type in the search bar, the ticker symbol, for example, JP Morgan, go to key data, and then go to overview, and then go down here to sector, and you can see the actual sector of the company that you're invested in. And then that way you can update your portfolio in that way. One thing that I will say though, when you are updating your slices in M1 Finance, this is the one thing that I am not a fan of when it comes to M1 Finance, is the updating your slices. So make sure that you're aware of how to do that. Do a Google search on how to update or remove slices, because that can be very frustrating if you're not used to it. You don't know how to do it. All right, let's take a look at another one. Hi, from David here. Hi, Jake. My name is David. I'm a big fan of your YouTube channel. Hey, thank you so much, David. I appreciate it. I'm 32 years old. I started investing in 2019 with TD Ameritrade. I recently found out M1 Finance platform through YouTube. I created my growth pies in June 2019. I added the dividend pie 3 months later. I'm all about growth stocks. Okay. I do want a taste of dividends. So the dividend pie was created. My plan is to reinvest those dividends into my portfolio and keep compounding. My investment time frame is 5 years or longer. I'm currently investing $170 a week. I would like to know your thoughts and changes you would make to my portfolio. Here's the link to my M1 portfolio. Thank you for your time. All right, well, David, hey, thank you so much, man. 5 years is not a long time. If you're looking to grow cash flow through dividend growth investing, it typically is going to take a much longer time frame than 5 years. Now, everything is obviously relative. $170 a week may sound like a lot of money to some people. It may sound like a very low amount to other people, right? Not everyone's in the same situation. I have to always remind myself, a lot of people living in New York and San Francisco, where their living expenses are 3 times what I'm paying here in Texas. So it's important to understand that everything is relative. All right, and so you're looking to mix growth with dividends, growth stocks with dividend stocks. Let's take a look at your portfolio. Okay, so in your portfolio, it looks like you have 95 holdings. That's a lot of holdings, a dividend yield of just over 1%, and a very small expense ratio. Okay, you have it broken down into your rescue pie, 42%, cloud 15, software 12, growth 12, medical 10, and security 9. Okay, so let's take a look at your highest allocated slice here, your rescue pie, and it looks like you have 73 holdings. So there's a lot of holdings in here. Okay, so it looks like you're taking an equal weighted approach here where each holding is weighted the exact same. Okay, so you got companies like Google in there, American Express, Microsoft, AT&T, Facebook. Facebook, I think you also had cloud and software. I mean, this could go in either slice, it sounds like. You got Clorox, you got Cracker Barrel, you got Campbell Soup, Intuit, MDT, McDonald's. Okay, so you also have some REITs in here with American Tower. You have some great companies. You got Waste Management, you got ADP, Bank of America, Apple. There's a lot of great companies in here, a lot of great names. What I would consider is there's a lot of companies in here. In order to follow up on all of these companies, it's going to be a second job, right? You're essentially creating your own index fund for free. I mean, you could go and you could get the S&P 500 from Vanguard and pay practically nothing and get, in most cases, a better performance, right? Because it's owned by the fund managers of Vanguard. Those a passive index fund, it's not a mutual fund, actively managed. You're still going to likely, you're going to have probably better performance with an S&P 500. You look at the last 5 years, S&P 500 index through Vanguard is up over 30% over the last 5 years. So you're not quite beating the S&P 500. So what I would consider is when you're first starting out, it can be fun, right? It can be a hobby. You're adding all of your holdings and it can, creating your pie. One thing that I would caution is understand that emotions are going to be high when you're investing into so many companies. So just really, really be aware of that. In your cloud slice, let's take a look and see what you have in here. You got Okta, Adobe, MongoDB. Okay, some really high quality companies, growth companies. Look, you can see here, man, that's amazing. 360. Growth, let's see what you got in here. Visa, Shopify, great companies. Like all 4 of these, I could see myself holding. I own Visa. I know Shopify, PayPal, great companies. All right, let's take a look at your medical slice here. You got Dexcom, Novo. Yeah, a lot of these companies I'm actually not familiar with. Okay, security, What do you got in here? 4 holdings. Oh, cybersecurity. These are good. These are going to do really well. I'm assuming like Zaskar. CrowdStrike is another great security company. I've been following them quite a bit, especially here in 2020 with everything going on. These are going to be doing, I would assume, do very well in this environment. Okay, so my initial feedback here is what I would recommend is I'm not a big fan of mixing growth stocks and dividend stocks in the same portfolio. The mindset is just so different. And this is what I've seen in my own experience. There's so fundamentally different the approach, investing for dividend growth and investing for growth to then buy low and then sell high. What I would recommend is if you're using M1 Finance, which you are, you can create sub-accounts. Create a sub-account like, you know, how I have my real estate portfolio and my cash flow portfolio. You can create a sub-account and then you could invest that way. You could have one portfolio, one account specifically dedicated to dividend companies and the other one dedicated to growth companies. That would be my opinion. That's something that I think it's easier for me to wrap my head around that way. And that way you have your goal of dividend growth companies in one pillar and your growth stocks in another. Biggest thing that I could tell you is keep it as simple as possible. All right, let's take a look at the next one here. Hi, Jake. My name is Sameh. I hope I'm pronouncing your name correctly. Big fan of your show and the series of Review My Portfolio. Hey, thank you so much. I appreciate it. I'm a doctor and I live here in UAE where the M1 Finance or even Robinhood are not available, so I'm using Interactive Brokers. I've actually heard really good things about Interactive Brokers. I'm 45, started January 2020. So far, my portfolio worth of almost $65,000, including $8,000 in cash at the time of the email. I am sending you screenshots of my portfolio in case you have time to review. You can definitely share it. Thanks and appreciate your time and effort. Regards, Sameh. All right. Well, thank you so much for sending this over. Let's take a look at your portfolio, the holdings that you have in here. It looks like it's weighted by market value being the amount that you have invested in the individual company. And the very first one is Microsoft. I love that you have Microsoft up here. If I could hold only one company or a handful of companies, let's say if I had just like, if somebody held me to it and said, okay, Jake, you can only hold 5 companies, what would they be? Microsoft would absolutely be on that list. Not far behind would be Johnson & Johnson and Pepsi, which I can see here as well. And as well as Apple. Like these are some of my favorites. Facebook, I think Facebook is a great growth company. I think you can't go wrong with Facebook. They're not going to be paying a dividend anytime soon, but they're a great company. Realty Income with O, great dividend payer. I think time will tell with the pandemic that's going on. I don't know how it's affected UAE where you're at, but it's impacting the US and a lot of other countries. So I'm curious to see what's going to happen with their dividend. I would likely hold on to Realty Income. If Realty Income were to cut their dividend, I would probably hold on to it. One of the very few companies that I would hold on to, even if they cut their dividend. I would have to see, for right now, I'm holding on to Marriott. I'm holding on to Darden Restaurants, the Olive Garden, simply because this wasn't a lack of management. This is nothing that they did that caused them to be in the situation they're in. For the most part, right? They're over leveraged, they have debt, etc. But for the most part, it's not like it was due to negligence or something like that. JP Morgan, one of the better banks out there. For me, financial companies right now are very difficult to predict with everything that is going on with low interest rates. Banks are not going to be as profitable as they have been. It's kind of a difficult time for them right now. Visa, great company. As I mentioned with those top 5 companies, Visa probably would be, if not in the top 5, top 10 for me. Coca-Cola, Merrick, Chevron, Citibank. I'm not the biggest fan of Citibank. I just, for me personally, it's so difficult for me to assess how banks are going to do. I like investing in the Vanguard industry specific bank ETF. And I'm going to talk about that in a future video. I've made a few adjustments, a few updates to my portfolio, my main portfolio, which I'm going to be hopefully sharing here this coming week. So stay tuned for that. Nike, love it. Pfizer, VPU. This is a really good one. This is a utility sector ETF. From Vanguard. Really, really good one. I like that. VYM. VYM is one of my favorite dividend ETFs by far. I really, really like VYM. A close second in terms of high dividend is the Schwab SCHD, but I like the Vanguard VYM just a little bit better. Abbott, I own AbbVie in my portfolio, Qualcomm, MDL, Oreos. Whenever I see this, I always think of Oreos. MDT, Welltower. Welltower just cut their dividend. They didn't suspend it, they cut it. But I'm currently holding on to them as well, kind of seeing what I'm going to do with them. Bank of America, Starbucks, and Store. I think that's it. Did I miss one? Oh, I clicked twice. I missed one. 3M, Disney, BND, AbbVie, Duke, Verizon, Home Depot, Dominion, Union Pacific, Washington Mutual, Raytheon, LQD. I'm trying to think of, not familiar with LQD. Southern Company, Intel, Cisco, and Honeywell. Great companies. I love the fact that you're going for big brand names. You're not going for small companies that nobody has ever heard of. In 2020 and beyond, larger blue chip companies are going to fare this pandemic much better than smaller companies. It's just the companies with the best balance sheets are going to do the best. I hate to say it, it's kind of the survival of the fittest right now with everything that is going on, with government intervention, government support, with stimulus. I think the largest companies are the best positioned for this environment. And Samet, I think you have a great portfolio. I love the fact that you're focusing on quality. You're touching many different sectors. I'm thinking about in my own portfolio, you have Pepsi, you have Coca-Cola, do you have waste management? For those of you who follow the channel, you know I love waste management. I don't see waste management on here. You have Honeywell, which I saw there. Honeywell's a great industrial. Trying to think of other sectors. Telecom, you got Verizon. Yeah, you got a lot of great diversification in your portfolio. I love it. You also have some really high quality sector specific ETFs in VPU. VYM, a big fan. If you're looking at dividend growth ETFs, my favorite dividend growth ETFs, there's two of them. Absolute favorite is VIG from Vanguard and DGRO from BlackRock. My two favorite dividend growth ETFs. And kind of a spoiler in my next video for next week when I share an update on my portfolio, those two in my portfolio are going to be making up a big chunk of my portfolio. So thank you so much for sending this over. I think your portfolio is great. I think you're doing a great job with the holdings that you have in there. You're 45. You're going to be able to supplement your living expenses with the dividend cash flow that you're getting from your portfolio. All right, let's take a look at the next one here. Austin writes, "Hi, my name is Austin. I'm 20 years old, working part-time at a gym and also going to college part-time. My goal with this is to eventually have my dividends to be one of my main sources of income. It's a taxable account, and I plan to start starting with $2,000 invested and then adding $200 a month for now. As I make more money, I plan on adding more every month." That's great. "I currently do $200 a month in the app Acorns and $25 a month into a Roth IRA. This M1 Finance would be additional and most likely the priority." Okay, great. When I set this up, I used a website called Simply Safe Dividends. Great website. I love Simply Safe Dividends. They research different stocks and give them a safety score that is supposed to correlate with how likely the company is to keep their dividend payout. This is great. A lot of other YouTubers talk a lot about this and use this service as well. Most notably is Andre Jix. If you follow him, he does a great job with that. "I set up this portfolio by reading Simply Safe's review on each stock, but I'm very open to criticism because I'm fairly new to investing. Thank you so much for your videos. I have found them super helpful and really appreciate them." Well, hey, Austin, thank you so much for the support. Thank you so much for watching the videos. And let's take a look at your portfolio. All right, so your portfolio right now, when I look at the overall historical performance over the last 5 years, it's fairly low. So it looks like you're going for more of a current high yield. So if you have a lower performance over the last 5 years, it means that you're focused more on a higher dividend, which you do have a little over a 4% dividend with 81 holdings. Okay, 81 holdings is a lot of companies, especially if you're just starting out, especially if you're new to investing. I will tell you right now, there's going to be a learning curve. If you have this many holdings, you're going to be tempted to sell out of these as you follow up on them. So be very aware of that. The best advice that I can give to anyone in personal experience is if you're just starting out, start out slow. read as much as you can, do as much research as you can, which you're doing right now, right? You're watching other videos on YouTube, you're doing your research, you're reading articles on Simply Safe Dividend, you're doing all the right things. So great job. The way that you have your portfolio allocated, you got real estate, financials, utilities, information technology, industrials, energy. Okay, great. Energy, I'm just looking at this off the bat here. Energy is fairly high. Basic materials is fairly high. Communications is fairly high. If you're 20 years old, you want to focus on growth. And you want to focus on the sectors that are growth sectors. Energy is not a growth sector. In my opinion, you could bring this down to 1 or 2%. I haven't looked at the holdings in there. I'm assuming it's going to be Chevron and ExxonMobil. Let's take a look. Well, not ExxonMobil, but Chevron's in there. So you got a lot of different companies in here. Canadian, are these MLPs? Yep, master limited partnerships. Okay, so these are high. You got 6.5% here. If you're 20 years old, it can be kind of, look at here. You got really low performance in terms of the share price, which is not a big deal if you're a dividend growth investor. You want the growth of the dividend. But once again, you want to focus on the dividend growth. So I would recommend bumping this down or lowering this, not bumping it up, lowering it to 1 or 2% for the energy and really focus on quality. A lot of these energy stocks, they're going to be cutting their dividend if they already haven't. So be very, very aware of that. Basic materials, 8%, Nucor, Eastman, Sonoco. These are great companies. What I would recommend is not all of these basic material companies are created equal. Sonoco, great history, great dividend growth company. APD, this is probably the best material company that you have in here, but it's one of the lowest allocated holding. What I would recommend is I would bump this up. Focus on quality. Not all of these companies are created equal. CE, also a great one, right? You could put APD way up there. If you look at Nucor Steel Company has a great track record, but you look at the dividend growth on seekingalpha.com, it has a 1 or 2% dividend growth rate over the last 10 years. You don't want that. What you want is you want that 7, 8, 10% dividend growth, and you're going to get that with other companies. So that would be my recommendation. Lower your smaller growth companies. And if you're not aware of how to do that, go to seekingalpha.com, go into dividends under the dividend tab, and then under the dividend growth tab, and see how quickly these companies are growing their dividend and allocate it accordingly. Companies that have a higher starting yield, that's great, but they're growing them much slower. And you want the dividend growth, especially if you're 20 years old. Okay, so let's take a look at your real estate here. You got Realty Income, PSA, love it. Cube, so some public storage companies, great. ELS, ESS, this is my favorite residential REIT. DLR, my favorite data center REIT. FRT, great retail REIT, great track record. These are really good. I like them. I think the only ones that I would add, if I could add to these, would be AMT, like cell towers, AMT, CCI. Those kind of REITs would do really, really well in your portfolio, as well as industrial REITs. Prologis is my favorite industrial REIT. Take a look at those. Those are really, really good. Financials, People's United, Prudential, Ben, T. Rowe, Ori. This is a really, really good one. BlackRock. I like them. They have good history. You don't have just traditional banks in there. Yeah. My favorite here is T. Rowe and probably Ori. Ori is a really good insurance, really good track record of dividend growth. Utilities, Dominion, UGI, OGE, Duke, DTE. You're missing probably the best utility out there for a 20-year-old. Next Era Energy, NEE. Take a look at that. NEE should make in my opinion, belongs in this type of portfolio. You should always have, in my opinion, you should always have NEE in here, Next Era Energy, and I would bump that up to 20-30%, in my opinion. Information technology, Texas Instrument, IBM. Where's Microsoft? Where's Apple? You're missing out on the best companies, the most profitable, largest companies in the world. Where are they? You got to have Microsoft. You got to have Apple in here. Definitely missing out, as well as information technology. in my opinion, you're 20 years old, this should be well over 10 or 15%, in my opinion. Therefore, you're gonna sacrifice the current yield, right? But you have time for it to grow. That's the whole point of dividend growth investing, is you're not going after that current yield, and you're not going to see a 3% return. Once again, this doesn't matter as much because you're looking at the dividend growth of your portfolio. But information technology, this should be over 10 or 15% if you're 20 years old. Industrials, waste management, love it. Raytheon, UPS, really, really good. 3M, good. All equally weighted, good. Emerson Technology, good. Healthcare, Johnson & Johnson, MDT. BDX is also really another good one, good healthcare company. Johnson & Johnson, in my opinion, is one of the best companies in out there. There's very few companies out there across all sectors that are better than Johnson & Johnson. In my opinion, it's a missed opportunity to not have more allocated to Johnson & Johnson. I would definitely bump up Johnson & Johnson. It's worth much more than the others, in my opinion. Consumer staples, let's take a look at it. Philip Morris. I have Altria Group in my portfolio. Philip Morris is also a good one. Walgreens, good dividend track record. Unilever. Now, I don't know where you're at. I've shared this in other videos. I don't have Unilever in my portfolio. The reason why I don't have it in my portfolio is because of the international tax. I've shared a video on taxes in a previous video, but instead of going with Unilever, what I decided to do and pay a tax, the country tax on the dividend, I went with Kimberly-Clark and Procter & Gamble, which you also have, Kimberly-Clark. So you can have it in there. Just be aware that the international tax is going to eat away at your returns. Pepsi, really, really good. Kellogg's, really good. Where I looked at energies, consumer staples. Wait, was that consumer staples? Yeah, that was consumer staples. Consumer discretionary, good. Best Buy, okay. Hasbro, with everything going on in China. I mean, they have a great track record, like really, really good. McDonald's, great. Communications, Verizon, Omnicom, Comcast, AT&T, Disney, great. All right, well, great. So I like your portfolio. Once again, if you're 20, you want to focus on dividend growth. You're missing a few things like Microsoft and Apple. I'm really, really surprised that you don't have Microsoft and Apple in here. Some of the best companies out there. I would really recommend lowering your energy exposure, lowering your basic materials exposure, communications. You want to focus on growth, and you want to focus not only on individual companies and focusing that way, but also on your sector allocation. I hope that helps. All right, let's take a look at another one here. Hi, Jacob. Thank you so much for making these videos. I don't have M1 because I live in Europe. I actually used to live in Europe, by the way. I used to live in Germany. I lived there for almost 10 years. Beautiful place. I did make an Excel spreadsheet. I would appreciate it if you could review. And I'm 19 years old. Goal is building passive income so I can become financial free. I'm adding 300 euros every single month. Thank you so much, Rubens. All right, Rubens, let's take a look at your portfolio. All right, Rubens, so your portfolio looks like you got Verizon in here, AT&T, Cisco. So your top three here are in the telecom sector. Chevron, Bank of America, ING, Realty Income, OZK, MDT, Pfizer, EPD, AbbVie, Cardinal Health, Pepsi, Coca-Cola, IBM. All right, so you got some really big names in there. You're 19 years old. You, like I mentioned in the previous portfolio that we just took a look at, you want to skew a little bit more towards growth sectors. You have IBM in here. IBM is not a growth. It's in the technology sector, but it's not really a growth company like Microsoft or Apple or Texas Instruments. So understanding that, I would say, adding exposure to these hyper growth companies like a Microsoft, a Visa, those kind of companies. Johnson & Johnson, really great, strong companies. Yeah, Visa, those kind of ones. Right now, your portfolio, the way that you have it set up, would be absolutely ideal if you were retiring today. If you were retiring today, this would be a stellar portfolio. This is a current income-oriented portfolio. You have right now over a 4.5% dividend yield. 4.5% is what retirees, what they're looking for or more actually. Hopefully their yield on cost is higher, but a current high starting yield, this is an income-oriented portfolio. You want a dividend growth-oriented portfolio, especially if you're 19. You're going to be paying taxes on this 4.5% up until you retire, which is not the end of the world. If you're paying taxes, I mean, that means you're making more money, right? Kind of, you can look at it that way, but you're 19 years old. You want to focus on dividend growth. Research around dividend growth companies that are growing their dividend around 10% every single year. I'll give you an example. Honeywell. Honeywell is an industrial company. It's growing they're growing their dividend over 10% every single year. Great company. Let me share one other thing. I can share what I do as well. Go over to ETF.com, type in ticker symbol VIG. It's the Vanguard Dividend Appreciation ETF. And what you can do, this ETF is focused on companies that are growing their dividend, or they've grown their dividend for consecutively over the last 10 years. And go down here to the bottom and take a look at the top holdings within this ETF and see, okay, what kind of companies are dividend growth companies? Dividend growth companies are companies that are growing their dividend faster than other companies, other similar companies, right? You got Microsoft and IBM, they're both technology companies, but Microsoft is a growth company. They're growing much quicker. So you got Microsoft, you got Walmart, you got Procter & Gamble. These are the kind of companies that you want in your portfolio. For example, you have Abbott, AbbVie, but you want companies that are growing a little bit quicker. I hope that helps. I think your mind is in the right place. Now it's kind of pulling it back and looking at not the current yield, but looking at the dividend growth. I hope that helps. All right, let's take a look at one more portfolio here from Alexander. Hey, good evening and happy Sunday. Thank you for replying to me on YouTube. This was my comment. So this was actually from last month. Alexander, sorry I haven't been able to get to this sooner, but let's take a look at it. Starting is key. I myself started about a month ago or so on Robinhood, and 2 weeks ago I opened up an M1 account. I would love to hear you, I would love for you to take a look at my portfolio. Being a beginner, I have trouble setting my allocation. I only have companies I love and know exactly what they do now and what they will be doing. Love your video and your perspective on things. I also have an account with Betterment I opened up last August for a set it and forget it kind of thing. I like that. I use it as my retirement account. I don't like RIASO. I have general investing account with them, but it must be in a company. Is this a Canadian company? I'm not sure. Maybe not. Being I have more experience now, I want to now have control of which companies I want. I keep thinking if I should have all of my shares transferred over to M1, as I love the control of which companies I want to own shares of. Any thoughts on this? By the way, I'm 35 years old, 2 kids, and an LLC business in their entertainment world, therefore want to retire in 15 to 20 years. All right, great. So Alexander, let's take a look at this. 24 holdings in the portfolio, over a 4% dividend yield. It's a pretty high dividend yield. Your top holding is the SPYD, so this is a high dividend. This is, if you've been watching the video straight through and you've watched all of the portfolio reviews, this is similar to your SCHD or your VYM, a current high dividend ETF. Your next holding is AT&T, Walgreens, a Taiwan Semiconductor. All right, so the first 10, 16, 20, about 20% of your portfolio, this is current income. So this would be something that a retiree would invest in if they were retiring today, for the most part. So it's important that you're aware of that. So if your investment time horizon is 15 to 20 years, you want to skew this more towards growth and less towards current income. Okay, so with that being said, you want to have lower exposure to current income and higher exposure to current growth, like growth, year over year growth, and not just growth in the share price, but in the dividend. Okay, going on, you got PPG. I really like PPG. It's a paint company. Lowe's, IBM, Emerson Electric, GPC, 3M, Coca-Cola, United Healthcare, Qualcomm, JP Morgan, Ed, Verizon, Realty Income, Johnson & Johnson, Extra Space, XLE, Aflac, Disney, Visa, Apple. Do you have Microsoft? Oh, you don't have Microsoft. A lot of portfolios haven't had Microsoft. Microsoft is one of the best companies. I would highly recommend adding Microsoft to here. Okay, so I'm going to repeat myself just a little bit here. So Alexander, you want to focus on dividend growth. You're only 35 years old. I'm just about to turn 34. You want to focus on dividend growth. Unless you're looking to retire in the next 5 years, you want to shake this up just a little bit. Okay, I think you could hold every single one of these in your portfolio. You could absolutely do that. Emerson Technology, one of the greatest dividend kings out there, been paying a dividend for over 50 years. IBM, dividend aristocrat, been paying for over 25 years, has over a 5% dividend yield, right? Great for current income, but if you have the time before you're going to need the dividends, you want them to be compounding and to grow. I shared a video on compounding interest, the miracle of dividend growth. Take a look at that video and see what the snowball effect would be over a 10, 15, and 20 year time period. Okay, so a lot of these are great companies. My only thing there is what you could do is, let me share what you could do. If you wanted to keep all of these holdings in here, which I think are great, what you could consider doing, making it really, really easy on yourself. I talked earlier about a dividend growth ETF in DGRO, ticker symbol DGRO, and VIG from Vanguard, the dividend appreciation ETF. What you could consider doing is simply adding one or two of those ETFs to your portfolio without increasing the holding number too much. So you would have 25 or 26, and then put 20 or 30% into those ETFs, and that would essentially give you the best opportunity for growth over a 15 or 20 year time period or time frame. If you don't want to go with the ETF route, I really like the ETF route. I'm doing that myself. What you could do is focus on individual companies and allocating them higher. For example, Microsoft, Honeywell, those companies that are growing their dividend over 10% year over year. And that's what you want to do. And then what you could do is lower your exposure to AT&T. I think AT&T is great, but maybe lower it to 1 or 2%. Lower IBM to 1 or 2% and have companies that are growing their dividend faster. Johnson & Johnson, they're growing over 7 or 8% every single year. You could bump that up to 5 or 6%, for example. Visa, has a very, very low starting yield, but they're growing their dividend over 15% a year. So you could definitely bump that up. So what you're doing is, and this is not uncommon, you have your lowest allocated holdings here and your highest growth opportunities. With Apple, Visa, Disney, and Aflac all growing their dividend around 10% a year, you should flip this. If you're 35 years old and you don't need your dividends to pay for your living expenses in the next 15 to 20 years, you need to flip it. Otherwise, you're going to have diminishing returns over that same time period. Okay, so I hope that helps. If you're unsure of, you maybe not so confident in individual stock picking for dividend growth, take a look at those ETFs, those dividend growth ETFs. I think they would make a great addition to your portfolio. Once again, ticker symbol DGRO and VIG from Vanguard. I hope that's helpful. And other than that, great companies in your portfolio. Really, really like it. Thanks for sending this over, Alexander. Thank you again, everybody, for sending over your portfolio. I really enjoyed looking and seeing what different people are investing in, different strategies that people are taking. If you would like me to review your portfolio in a future video, send me over an email. Give me a little bit of information, your age, how much you're investing every single month, and your goals with creating cash flow from dividend growth investing. I'll do my best to share in a future video. If you like the video, hit the like button, subscribe to the channel, and I will catch everybody in the next video.